Hey Karen.
Hello.
All right, we'll give it about one more minute and then we'll go ahead and get started. All right, we'll go ahead and get started. Perfect. Thank you for hopping on another episode of Be the Market Expert. Let me go ahead and share my screen and we'll get rolling with the normal article we get started with from Logan. Perfect. All right. So we're going to get started here with keys to the housing market for the rest of 2026. Again, this is the weekly article that Logan Motoshami releases every week. So we'll just go ahead and dive right into the weekly pending sales. So what we're seeing, pending home sales did continue to outperform last year's pace. So this year we're at 75,489 this week, and last year we were at 70,352. So you'll see here on the graph, obviously we're above, which is roughly about a 7.3 year over year increase. And it's showing buyers are still writing contracts despite the mortgage rates remaining in the mid 6% range. So obviously pending sales are one of the strongest leading indicators in real estate because they typically become closed sales within 30 to 60 days. So it is a good kind of forward indicating thing that we can look at. If pending sales do continue to trend higher, we should expect existing home sales to remain healthy through the second half of the year. Now, what is driving that increase? Obviously, the biggest factors continue to be the mortgage rates. Historically, once mortgage rates move above 6.64, usually pushing towards 7%, the buyer demand tends to slow considerably. This year, the rates have fluctuated, but they've generally kind of stayed below that key threshold, allowing buyers to continue adapting to today's market instead of, waiting on the sidelines. Now, the second half of this year will kind of be important to watch. Existing home sales did see a strong finish to 2025 as mortgage rates declined later in the year. So we could see the year over year comparisons becoming much tighter beginning in July. Now, even so, the continued growth in the pending sales would be another sign that buyers are adjusting to current affordability conditions rather than waiting indefinitely for lower rates. Now, obviously, as we're seeing here with pending sales, the housing market continues to show resilience. While affordability remains a challenge, buyers are proving that they're willing to move forward when life events require it. So, as long as the mortgage rates avoid another push above the 7% range that we don't like to see, the pending sales should continue providing a solid foundation for the market. So, what we can take away from the pending sales is that the buyer demand does remain stronger than many headlines suggest. Pending sales indicate closings should stay relatively healthy over the next 1 to 2 months. And this is a great reminder that buyers aren't waiting for perfect rates. They're adapting to today's market. So we need to continue encouraging hesitant buyers to focus on long-term goals instead of trying to perfectly time interest rates. So as we dive into the mortgage purchase application data, now again, mortgage purchase applications declined 3% from the previous week, but they remained 5% higher than the same week last year. So while a single week's decline isn't unusual, the year-over-year data continues to paint a positive picture, which is purchase applications have now posted 21 positive year-over-year readings in 2026, with 10 of those showing double-digit growth. So what we've kind of seen is we have 10 positive week to week, 11 negative week over week, two flat weeks, 10 weeks of double digit, 21 weeks of positive year over year, and then two negative year over year. So again, why this matters, obviously purchase applications are also one of the earliest indicators of future housing activity, and buyers typically apply for a mortgage about 30 to 90 days before closing on a home. So making this one of the best ways to gauge where the market is headed. Even though enough applications dipped slightly this week, the consistent year-over-year growth is something that suggests buyers are still entering the market. Now, mortgage rates obviously continue to be a biggest factor influencing buyer activity. Earlier this year, lower mortgage rates helped create momentum that carried into spring market. While rates have climbed closer to their higher levels of the year, they have generally remained below the 7%, which again will historically cause that significant slowdown in demand. So the question for the second half of the year is whether buyers will continue moving forward if rates remain elevated or if the activity begins to soften as affordability pressures persist. Now, in Colorado, we're kind of seeing a similar trend across many Colorado markets. While buyers have become more selective, they are taking longer to make their decisions. They're still actively entering the market. Many are adjusting their expectations on their price, on their location, on their home features, rather than putting their plans on hold altogether. So the housing market does continue to show steady demand, even with these weekly numbers fluctuating. Definitely with this one week doesn't establish a trend. The broader picture tells us that buyers are still applying for mortgages at a higher rate than they were a year ago, which should continue supporting home sales in the next months. Now, as we move down to housing inventory, so what we're seeing with housing inventory is that housing inventory continued to increase last week, rising from 816,000 to 830,000 homes. During the same week last year, inventory increased from 825,000 to 828,000. So while inventory is still growing, the pace of that growth has slowed considerably compared to last year. In fact, inventory has been essentially flat on the year-over-year basis, fluctuating with a narrow range of about 2% above or below the 2025 levels. And we've kind of seen that in the last few weeks as we're right on the line there. So obviously, inventory is one of the best indicators of how competitive the housing market is. More inventory is generally going to mean that buyers have more choices and more negotiating power. Less inventory tends to create more competition among their buyers. After seeing inventory surge by as much as 33% year over year during 2025, many analysts do expect that the trend will continue well into 2026. However, instead, the growth has leveled off. So the market began shifting around mid-June of last year when mortgage rates started improving and the buyer activity picked up. As more buyers returned to the market, they began absorbing the additional inventory that had accumulated during 2025. So today we're seeing the supply and demand find a healthier balance. New listings continue coming onto the market, but they're being watched by steady buyer activity, preventing inventory from growing at the pace many expected. The next trend to watch will be how inventory responds if mortgage rates remain below 6.75 through the remainder of the year. So as we dive into new listings, what we see here is new listings. Oh, sorry. New listings did total 76,573 compared to 76,179 during the same week in 2025. So we're kind of slightly just above. Now, while that's a slight year-over-year increase, we're entering the time of the year where new listings traditionally begin to decline after the spring selling season. One trend, though, has remained constant throughout 2026. We're still not seeing a number of new listings that would be considered normal in a healthy pre-pandemic market. So why does that matter? Well, new listings represent fresh inventory entering the market. They do help us understand whether more homeowners are deciding if it's time to sell. So if you've been on this class, historically, the seasonal peak would bring 80,000 to 100,000 new listings per week nationwide. This year, we've only surpassed 80,000 listings 4 times, and it's never been in consecutive weeks, which that tells us many homeowners are still choosing to stay put, likely because of today's mortgage rate environment. Many current homeowners are locked into those mortgage rates well below today's market rates. Selling often means they're giving up their 3% mortgage for one closer to 6.5%, making many homeowners hesitant to move unless they truly need to. And as we move through the summer and into the fall, it's normal for new listings to taper off. The key isn't whether listing activity shows, it's whether it behaves similarly to the seasonal patterns from previous years. And again, I think we're seeing the same pattern throughout much of Colorado. While more homes are hitting the market compared to the ultra low inventory years, we're still not seeing a wave of homeowners rushing to sell. Many Colorado homeowners continue to stay in place because they're locked into historically low mortgage rates, which is helping keep the inventory balanced, even as the buyers have more options than they did just a few years ago. Obviously, one of the biggest misconceptions in today's market is that the inventory is rising because sellers are flooding the market. The data tells a different story, though. New listings do remain below historical norms, meaning inventory is growing gradually, not because of an oversupply of homes, but because the market is returning to a healthier place. This continues to support a balanced market rather than one that heavily favors buyers or heavily favors the sellers. So, what we do kind of take from the new listings is that the new listing activity remains below the historical season norms. Many homeowners are still staying put because of their low mortgage rates. The inventory is growing gradually, but not because of an oversupply of homes, and the seasonal slowdowns in the new listings are expected as we move into the second half of the year. So let's dive into price cut percentage. So the percentage of homes with the price reduction last week was 38.62%, compared to the 40% during the same week in 2025. While it may seem high at first glance, price reductions are a normal part of the housing market. Typically, we see about 1/3 of homes will adjust their asking price before selling, and that's just a national average. The important takeaway here that it isn't nearly that 39% of homes are reducing their price, it's that fewer homes are reducing their price than they were a year ago. Price reductions do give us an insight into the balance between buyer demand and seller expectations. If demand were weakening significantly, we'd expect to see a sharp increase in price cuts as sellers compete for fewer buyers. Instead, price reductions have remained below last year's levels for most of 2026, as we kind of just tucked right underneath there every time, which does suggest that the market continues to absorb inventory at a healthier pace. Now, the biggest factor again with this one is the mortgage rates as well. Throughout most of 2026, the rates have remained below that critical level. The steady demand has helped keep price reductions relatively stable, even as the inventory has improved. If we look ahead, one of the biggest things to watch for is whether mortgage rates will remain above 6.5% during the second half of the year. And if they do, we'll begin comparing today's market against the period in late 2025 when the rates were actually falling, making year-over-year comparisons more challenging. If rates stay relatively stable, we should expect price reductions to remain close to the current levels. But if the rates do climb back up to 7%, sellers may need to become more aggressive with their pricing. Again, I do think we're seeing this in the same kind of story in Colorado. Homes that are priced correctly and marketed well are still attracting strong interest. But on the other hand, listings that are overpriced and don't reflect the current market conditions are sitting longer and requiring price adjustments. Today's market isn't punishing sellers, it's rewarding realistic pricing. So I definitely believe that that's our opportunity to have these conversations with our sellers beforehand and make sure that they understand where the market's at and why we don't want to chase the market. And then we get down into mortgage spreads and 10-year securities, all that fun stuff. So we're going to move on to the next article here. Now, this is another merger acquisition article. So I'm not sure if you heard, but Bed Bath & Beyond also bought Fathom. So what we're seeing in this article here, let's kind of shift gears and talk about something that's happening clearly in our industry that we've seen consistently. So last week, Bed Bath & Beyond announced it announced that it is acquiring Fathom Holdings, which is a real estate brokerage. Now, on the surface, it seems like a really odd combination. You might be thinking, why would a furniture retailer want to own a real estate company? But then if we take a step back, it actually starts to make a lot of sense. So think about what happens after someone buys a house. They don't just move in and call it a day. They buy furniture, they paint, they remodel, they hire contractors, they refinance, they decorate, they landscape, all that fun stuff. A home purchase does kick off a year of spending. This acquisition, I believe, recognizes that buying a home isn't a one-time event, it's the beginning of a long relationship. So in the bigger picture of this, I don't think this is really a story about Bed Bath & Beyond. I think it's a story about where our industry is headed. Companies are starting to realize that the real value isn't just helping someone buy a house. The real value is staying connected with that homeowner for the next 5, 10, or even 20 years. And that's where the opportunity is. So here's the question I want all of us to kind of think about. What happens after you close? Do your clients only hear from you when they're ready to buy or sell again? Or are you staying in their world? Because if someone thinks about you every time they have a home question, whether it's remodeling or refinancing or even finding a contractor, you'll probably be the first person they call when it's time to move. And this is something that I think Keller Williams has been teaching for years. Gary Keller has always talked about building relationships instead of chasing transactions. Your database isn't just a list of past clients. It's a community of homeowners that you continue to provide value to over time. And I think that's exactly where this industry is heading. I don't know if this is specific partnership becomes, a huge success, but I do think it's a sign of what's coming, obviously what we've seen too in the recent history. The companies and the agents that stay connected after closing are going to have a huge advantage over the ones who disappear until the next transaction. So think beyond the closing table, stay connected with your clients throughout their home ownership. Figure out follow-up ways for them. Look for ways to provide value all year long. Relationships, not transactions, will continue to be your biggest advantage. The future of real estate isn't just helping people buy a home, it's becoming the first person they think of for anything related to home ownership. So as we dive into the next article here, what falling prices mean for your real estate business. So, this article, what it's talking about, let's build on kind of what we just talked about. If you were scrolling through the news this month, you probably saw a headline like the largest home price drop in 9 years. Now, if that's all you read, you'd probably think the housing market is in trouble. But once again, the headline doesn't tell the whole story. Nationally, the median list price declined about 2.4% compared to last year. And at first, that does sound alarming, but here's kind of what caught my attention. The percentage of listings reducing their price actually went down compared to last year. If the market was truly crashing, we'd expect the opposite of that. We'd expect sellers to list high, sit on the market, and then start making large price reductions. And that's not what's happening. So, what's really going on? I think this market is simply normalizing, as we've talked in recent weeks. For the past few years, sellers could almost name their price. Today, buyers have more choices. That doesn't mean that homes are selling, it means sellers have to price their homes correctly from the beginning. And when they do, the buyers are responding. In fact, the pending sales have increased for 6 straight months. That doesn't happen in a market that's falling apart. My take on this article, it actually validates everything we've already looked at today. The pending sales are up, the purchase applications remain positive, the inventory is balancing, the price cuts are lower than last year. Now we're seeing list prices soften a little, and to me, this doesn't describe a weak market. It describes a healthy market that's finding its balance after several years of extremes. I think the media loves dramatic headlines that are there to create fear, and as agents, it's our job to explain what's actually happening. Now, what we kind of want to know or need to know from this article, kind of why I wanted to bring it up, a lower median list price doesn't automatically mean the market is declining. Sellers are pricing homes more accurately from the start, which is what we've been talking about for months. Buyers are responding to realistic pricing, and skill matters more than ever in today's market. This is a market that's going to reward the knowledgeable agents, not just the order takers. So let's move into this next one. Now, with Warsh's Fed overhaul, mortgage rates face a new risk. So let's talk about interest rates for a minute. Last week, the new Federal Reserve Chair, Kevin Warsh, introduced a completely different way of communicating with the markets. So now, before you your eyes glaze over, here's why this matters. The Fed isn't necessarily changing interest rates. They're changing how they communicate about future interest rates, and that can make mortgage rates a little more unpredictable. In the past, the Fed gave investors a pretty good idea of where they thought the rates were headed, and that helped the markets stay relatively calm. Now they're saying we're going to stop trying to predict the future. Instead, they're going to react as new economic data comes in. And that means that the markets have less guidance. And when markets have less certainty, they tend to become more volatile. So, what does that mean for us? It doesn't necessarily mean mortgage rates are going higher. It doesn't necessarily mean they're going lower either. It means we could see them move around more from week to week as investors react to inflation reports or to job data or even economic news that instead of waiting for the Fed to tell them what to expect. One thing the Fed made very clear in this article, it says that inflation is still their number one priority. And until inflation gets closer to their 2% target, they're likely going to keep a cautious approach. My take about this, I think this is a great reminder that we should get caught up and we should not get caught up in trying to predict mortgage rates. Every year, someone's going to ask, when are rates coming down? The honest answer is nobody knows. There's simply just too many moving pieces. What we do know is that buyers have continued moving forward even with the rates in the mid-6 range. We've already seen that in today's pending sales, in the purchase applications, the inventory, the price cut data that we've already talked about. The market has proven it's more resilient than many people expected. So if you have a client that says, should I wait until interest rates come down? Here's what I would say to them. Everyone wants lower rates, but nobody can accurately predict when they'll happen. The market has continued moving even with today's rates because people still have life events that require buying or selling. If buying a market, or sorry, if buying a home makes sense for your situation today, trying to perfectly time interest rates usually is not going to be the best strategy. All right, let's move into our first Inman article. So the participation crisis nobody wants to talk about. Um, Now, this article kind of made me think. It talks about what the author calls the participation crisis in real estate. And honestly, I think every brokerage in the country is dealing with this in some way. Agents say they want coaching, they want accountability, they want culture, they want training, they want community. But attendance at meetings, at the workshops, at the coaching calls, and at the office events continue to decline. The interesting part is that this isn't just happening at one brokerage, it's happening everywhere. So traditional brokerages, virtual brokerages, coaching companies, associations, everyone is asking the same question. How do we create engagement when participation is completely optional? And I think this article points to something much bigger than attendance. The way agents learn has completely changed. 10 years ago, if you wanted to learn something, you had to come to the office. Today, you can watch YouTube, you can listen to podcasts, you can use AI, obviously, you can join Facebook groups or even take online classes. The information is everywhere. The challenge isn't access to the information anymore. The challenge is turning the information into the action. And this is where I think relationships still win. Technology has made learning easier than ever, but technology can't replace proximity. It can't replace sitting down with another agent who's been through what you're going through. It can't replace asking questions after a class. It can't replace accountability. And it definitely cannot replace the relationships that we build. I don't think the agents who are growing the fastest are necessarily the smartest agents, but I do think they're the ones who stay connected. They ask the questions, they collaborate, they show up. And it's not because someone makes them, it's because they understand there's value in being around people who can help them grow. Tying this to Keller Williams, I think this is actually one of the reasons Keller Williams has always emphasized training and culture. Not because we want to make or we want people sitting in meetings for the sake of sitting in meetings. The goal has always been to create opportunities for learning, for collaboration, and accountability. And as our industry evolves, maybe that doesn't always look like a weekly office meeting, but maybe it's masterminds or smaller groups or even AI. Maybe it's even one-on-one coaching. The format might change, but the need for connection does not. So information is everywhere. Growth happens when you combine that information with action, accountability, and relationships. All right. Now, this is something kind of interesting as well that I wanted to bring up. We're kind of going to do a change of pace here. So I wanted to finish with our Inman articles today with something that's kind of practical. This article introduces a simple system called the 5 by 3 by 90. And the idea is very straightforward. For 90 days, you record 5 short videos each week. Share each one on social media and then send that video directly to 3 people in your database. Then the following week, you follow up with those same people and you simply just ask them if they had a chance to watch it or if they have any questions. And that's it. I don't think the magic is in the numbers. I think the magic is in the consistency. And so many agents think they need a better CRM, better marketing, better technology, or a bigger advertising budget. Most of the time, they don't need a better system. They need a system that they'll actually stick with. So, what I really liked about this article, excuse me, is that it flips lead generation upside down. Instead of calling someone asking for business, you're reaching out because you already given them something valuable. Maybe it's a quick market update. Maybe it's explaining seller concessions. Maybe it's talking about, what's happening in their neighborhood. And then your follow-up call isn't awkward. It's simply, hey, I sent you that video last week. Did you get a chance to watch it? Any questions? And that's going to lead to a much more natural conversation. So I think this article does reinforce something that we've talked about in this class before, obviously. The agent who consistently win usually aren't doing the one giant thing. They're doing a lot of small things consistently. 5 short videos every week doesn't sound life-changing, but after 90 days, you've created 65 pieces of content and you've reached nearly 200 people directly. And you've probably had dozens of conversations around that as well. And you've stayed in front of your database without constantly asking for business. And that's how your momentum is going to get built. And it does line up, I believe, perfectly with what Keller Williams has always taught. Your database is your business. The goal isn't constantly to chase new leads. The goal is to stay in relationship with the people you already know, like, and trust you. Video is simply another way to provide value and stay connected. So I do want to leave you with a little challenge from this article. Don't worry about filming 5 videos this week. Just film one. If you're going to do one thing, film one video, answer one question that your clients might ask all the time. Then post it, send it to 3 people, and follow up next week. And then sometimes the hardest part isn't going to be creating the momentum, it's just getting started. So just start with one video. And I believe that it'll be beneficial for you and your business. All right, and last one on a lighter note, just because I thought this would be kind of fun and it caught my eye. So apparently, one of the fastest growing home trends in America right now is bird watching. So since the pandemic, millions of Americans have picked up bird watching as a hobby, and today nearly 59 million households have bird feeders, bird baths, or bird houses in their yard. Americans now spend over 4 billion a year on bird food alone. Which, I definitely didn't have that in my bingo card for 2026. Retailers are paying attention. Stores like Ace Hardware have expanded their birding sections because the demand keeps growing. We're even seeing bird feeders with built-in cameras so homeowners can watch and identify the birds visiting their yard. I didn't know, but I don't know if you knew that bird watching had gone that high tech. Again, I just thought this was a fun reminder that people don't just buy houses, but they buy a lifestyle, whether it's a mountain view, a backyard for kids, a garden, or even a place to watch hummingbirds. People buy homes because they picture the life they'll live there. As agents, we sometimes get caught up in square footage and the interest rates and the price per square foot, and our clients are usually thinking about something much more emotional. So if there's something to take away from this article, next time you're showing a home, don't just point out the granite countertops or the new roof. Point out the backyard, the mature trees, the quiet mornings, the hummingbirds, whatever it is to help your clients imagine living there. Because people don't fall in love with the houses, they fall in love with the life they picture themselves living. All right. Now, I did want to dive into our local Colorado market as well. So, for those of you who were not on last week, new listings, we saw those at 1,636, and they're now at 1,656. So, what a 30 home increase there. Coming soon last week was 217. We're now at 232. It's a little bit of an increase there. Back on market last week, we were at 328 and we're at 302. So, a bit of a decrease there. And then price decrease last week we were at 2,223 and now we're at 2,313. So we did see an increase there of about 90 homes. Pending, we saw or last week we were at 1,386. This week we're at 1,251, so another decrease there. And then closed last week we were at 1,105, and this week we are at 1,050, so another decrease there as well. So if there's a final thoughts from everything we've talked about before we wrap up today, I kind of want to leave you with just one thing. If you look back at everything we just talked about, there was one theme that kept coming up over and over again. The headlines rarely tell the whole story. The headlines say the market is slowing and the data says that buyers are still buying. The headlines might say the prices are falling, but the data says the market is becoming more balanced. The headlines say that interest rates are uncertain, but the data is going to say that people are still making moves because life doesn't stop. The headlines tell one story, the data tells another, and that's exactly why what we do matters. Your clients need someone to don't need someone to read headlines to them. They need someone who can actually explain what those headlines mean. And that is what being a market expert is all about. It's about bringing clarity when everyone else is bringing confusion, replacing the fear with facts. It's about helping people make confident decisions based on data, not just emotion. And the agents who are doing this are going to build their trust, and trust is what builds their business. So I never want to leave you with just more information. So again, I want you to try something new. That short video. Um, Answer, maybe the question that you're trying to answer is, should I wait for rates to come down? Are home prices falling? Is now a good time to buy? Why are some homes sitting longer? Keep it under 2 minutes. Post it to your social media and send it directly to 3 people in your database. Next week, follow up with those people. And again, just ask them one simple question. Hey, did you get a chance to watch the video? Or do you have any questions about the video? That's it. Don't overcomplicate it. One video, 3 conversations. Momentum's going to start with one small action. So again, remember technology is changing, AI is changing, the market is changing, the industry is changing, but one thing hasn't changed. People still want someone they trust to help them with the biggest purchase or one of the biggest financial decisions of their lives. That will never go out of style. Continue learning, continue asking questions, continue staying connected, continue hopping on this Be the Market Expert class every week, because the goal isn't just to sell more homes, the goal is to become the trusted expert that the community thinks of first. And if you keep showing up, if you keep learning, and you keep providing value, the business will follow. All right, that's all I got this week. Have an awesome week, everyone, and I hope to see you next week.
Thanks, Chris.
Thank you, guys. Thank you, Karen.